All right, we're live. Thank you very much for joining me. We've got a couple of things to talk about. Yeah, just another mildly down day in the market, which masks the really horrendous day that we that we started with. So the major averages really took it on the chin earlier today. The Dow was down over 600 points at one point, but it closed down about 100, which is really no big deal. But it's clear that the general trend is just like the market's having a slow melt at the end of the day, in spite of the volatility intraday. So the whole thing is interest rates, inflation, and what is the Federal Reserve going to do? We had a big inflation report this week. Inflation up 9.2%, highest since 1981. We had a big, really strong employment report though last week. So strong employment, high inflation. It's the perfect cover for the Federal Reserve to raise rates, squash demand, and lower inflation. It's a really blunt instrument, and it's a shame that that's the instrument we have to use. But then again, this is the hangover. So let's call this market that we're in now the hangover market. It's the hangover market from all of the pandemic and post pandemic stimulus from the government and all of the bond buying and interest rate cuts from the Federal Reserve. We had a party, the market went up, speculative stocks went up the most, the pandemic stocks, the meme stocks, the SPACs, special purpose acquisition companies, and crypto. The worst stuff went up the most. And we had a party, and now we're suffering the hangover. That's what this is. This is the hangover market. Does that make sense to you? But we're going to talk about calm, and I think you could tell from my demeanor and how I conduct myself and how I conduct this live stream. And if you're my client, I'm pretty calm about this stuff. Uh, Unflappable. This doesn't really get under my skin. So how do I maintain my calmness? How do I not flip when I woke up this morning and saw the futures down 500 points, on the Dow this morning? I was like, all right, whatever, walked my dog, had my coffee, drove my kids to where they had to be, hit the shower and came to work. No big deal, right? Anyway, the Dow was down 100, not that big of a deal. So I want to talk to you about calming strategies, what to look for. We'll go over a quick summation of the market. This is Thursday's show, so it's the last one I do for the week. I'll be on Fridays only if we have like a major down day on a Friday, then I'll be on the live stream. But other than that, that's just Friday's kind of like my day to catch up on everything that I've neglected during the week. And just how it is. Stuff piles up, and if I showed you all the little piles on my side of my desk, like right here, and on the floor down here, like right down there, it's just I've got to clear the decks. Plus, that stuff gets me a little stressed out. So, while you're watching this, or if you're watching this in the replay, hit me up with a thumbs up, or a heart, a love, an applause, depending on which social media platform you're watching me on. I always appreciate that. I take care of the shows, the expense of the equipment, the show, the time. So anything you could do to help support me, I really appreciate. And when you give us a reaction on social media, it helps spread the word to other people that you're interested in it. Maybe more people will come into the fold. Okay. If you have any comments, or if you have any questions, I'm not supposed to ask for comments. I'm allowed to ask for questions. So if you have any questions, please hit me up in the comments. Words of wisdom, though, are always appreciated. A good story that you could tell that how you've overcome a challenge. That's always like the best part. And I love to hear from you, and I'd love to get a little banter back and forth. If you're interested in being a guest, let me know. Wendy, thank you so much for the like, for the thumbs up. You are so awesome. Thank you. So we've got a bunch of things going on. So what I'm going to do is I'm going to roll the intro. We're going to take a look at the three big data points that you need to look at right now. So actually, three. I have it down to 3 data points, and they all are working hand in hand. And it's really strange how they're all hitting such extremes now. and they're all either at 52. They're all at their high point. We need to check that out. So let me go roll to the intro, and we'll talk about the inverted yield curve and interest rates, inflation, what's going on, and some calming things, and why I am really never like I don't. This stuff just doesn't make me crazy. I've been doing this too long to let anything get under my skin. What can I tell you? You can't be a financial advisor for 30+ years if stuff gets under your skin. Not if you want to be healthy, right? Here we go. All right. Thank you. We're back. And thank you so much for joining me. We're just getting started. I'm Mitch Goldberg. You're watching my live stream, Be the Boss of Your Money, which is a show about taking control of your money, because it's very easy for your money to take control of you. We become a subject of our money, of our or lack of money, of our poor financial decisions, of our material things. And we realize one day maybe we're not happy. So maybe the show is also about happiness. And believe me, if you know me, happiness is a good thing for me right now. Okay. So let's talk about a couple of things. So, first thing we're going to take a look at is the overall market. And then we'll get into like the strategies and all that good stuff. Right. I'm going to put this up on my screen. All right. Here I am. Here I am up in the corner. Hello. Dow down 142. All right, no big deal, down 0.5%. NASDAQ up ever so slightly. S&P down ever so slightly. So the NASDAQ was up 0.03%. The S&P was down 0.03%. That's about as flat as you get. Oil continues to go down. I'm sorry, gold. Excuse me. Gold continues to go down. Gold looks like it's going to go into the 1600s. Oil was off earlier today, but still 96, maintaining an under $100 number. The 10-year yield was barely up today. The yield has been going down as the strength of the 10-year Treasury keeps pushing the yield lower. And why is that? Why are investors going to the 10-year yield? Because they're worried about recession. They're worried that the economy has a lot of cracks underneath the surface, and that's really important to discuss. We'll do that in a second. The VIX, let's over here, down a little bit. So even though the market was down, see down 142, only up down 11. I'm sorry, down 11 on the S&P. The VIX was still a little bit lower. That's a good thing, by the way. All right. So we're just talking about oil and the 10-year Treasury. So this is the battle in the market right now. The battle is it's I'm trying to think about a little dry in here. Believe me, I'm suffering from my allergies so bad this week. The battle is, are we in a recession or are we heading into a recession? There's a small group of people who are like, oh, we're not going to go into a recession. We're going to skirt by it. And it's really tough to say who's right, obviously, until after the fact, because none of us are fortune tellers. I do think, based on my work, based on what I see, is we're probably in a recession now. And that's why you're seeing interest rates, long-term rates, starting to actually go down again. And the Federal Reserve has probably done a lot of its work by reining in demand, right? Because if you have inflation, how do you get rid of inflation? Higher prices, right? Persistently higher prices. How do you get rid of it? Either raise the supply of everything that you buy or lower the demand. Since we can't raise supply because there's issues with regard to shipping and supply chain issues, and there's war. There's so many things going on in the world. So the only thing we could do is really hurt demand. If you hurt demand, you hurt the economy, and you hurt mom and pop small business owner. You hurt the man and women on the street because you're hurting the standard of living, right? If you're making borrowing on a credit card more expensive, or home equity loans more expensive, or mortgage rates more expensive, it's going to hurt demand. So we're not going to buy as much stuff and travel as much, things like that. Hey, Rianne, I see you. Thank you so much for joining me. I heard you called and spoke with my mother today. I really appreciate that. Thank you. It's awesome. I'd love to catch up with you soon. All right. So, what else? So that's the battle. My thinking is we're in the recession. Some people say, how could that be? Because unemployment is so low, job openings are still so plentiful, and it's just it's very it's very odd to see a recession with those positive traits. I get it, but those positive traits could turn around pretty quickly. And they're lagging indicators, just like I said yesterday when the inflation figures came out, 9.2%. All right, on the CPI number. I said it's probably the highest. It's because already because that measured June, but since July 1st to now, oil has come down, metals have come down, agricultural products have come down in price. A lot of the raw goods are going down in price, and that'll eventually trickle down to the. Don't get me started with trickle down economics. I'm just saying the lower commodities prices will trickle down to you know the cost of everything else that's manufactured. I don't think wages come down unless we really hit the economy. Okay, it's hard once wages go up. It's very hard to take higher wages back. I'm not against higher wages, by the way. I'm all for higher wages. I want everybody to make more money, but from a markets standpoint, from an economic standpoint, higher wages, uh, if it doesn't contribute to more productivity, more economic activity, then it's just inflationary. All right. And what we need to make higher wages more productive and more stimulative is for inflation to go down so that your wage increase will be more than the inflation increase. And that means you are better off. That means your misery index has gone down, your pleasure index has gone up. Anyway, that's what the Fed's trying to do. They're trying to squash demand. And it looks like they're doing a pretty good job of it. They've got further to go. They've got good cover to raise rates with a strong employment number last week and a high inflation number this week. All right. So are we in a recession? Or are we not? I think long term, for my purposes, for my own investing, my clients, we're going to keep doing what we're doing anyway. So there. Let's take a look at bonds, and this is a good segue into the rest of what we're going to talk about. Okay. The 2-year Treasury is at 3.13. The 10-year at 293. See, the 10-year 293 is below the 3.13. That shouldn't be. That's an inverted yield curve. It's like the biggest inversion in a yield curve we've had since like the year 2000. All right. But generally speaking, short rates have gone down a little, long rates have gone up a little. Usually we've been getting the opposite of that stuff. In any event, that's a good segue to the three big pieces of information that we need to look at. Okay. The yield curve is negative 0.17, and that hit a 52-week low today. See that yellow line? That just tells you that things continue to deteriorate with the bond market, and that we're going further and further into an inverted yield curve, which means that it's a really strong indication that um, we're going into a recession. And we've been talking about that, so this is just more proof, more stronger of an indication. And then we get into the Dixie. That's the U.S. dollar currency index. Look at that yellow line again, 52-week high today. So the dollar is just getting so strong versus a basket of currencies. I mean, come on, a 52-week high again today. So when you have the inverted yield curve at a high for the year and the Dixie at a high for the year, that is just so negative for the outlook for the U.S. economy. It's just so freaking negative for the outlook. And this is one of the things that's spooking professional investors and retail investors alike. Let's take a look to see who's out here. Rhonda. Once rents go up, they will never come down. So true. It really takes it would take like a major, economic calamity for rents to actually go down. I could see the cost of a house going down. And if the cost of a house goes down, well, yes, rates are higher, but owner's equivalent rent, that's very high. So it's we'll see how the equilibrium changes. All right. What's more important for a first time home buyer? I'm talking millennials and Gen Zers. Okay, because millennials are in their 40s now. The leading edge of millennials. So these are the people that have, on their first kid or second or third child already. They've got two cars, dual income family, and they're moving to the suburbs. All right. So we have to even think about the millennials now. I think there's still more millennials than there are Gen Xers, probably more than boomers also, but we're going to move on. The millennials are like my kids' age. All right. Um, what's more important, the size of the down payment or the monthly payment for a house? So if a house is 500,000, you need at least $100,000 to buy the house. Now, what if the house is 400,000? Well, now you only need 80,000 to buy the house. You need a smaller down payment. I'm going by 20% down payment. So the affordability in terms of the down payment is better, but the interest rate is a lot higher. So you're still paying through to carry the house a lot more. There's no free lunch is what I'm trying to say. There's going to be no bargain. All right. And lastly, 30-year fixed, 52-week high today. I don't see why it says 52-week high today. It's been higher, but anyway, 5.77%. So mortgage rates are still pretty high. Let me just show what I'm looking at. Okay. So it says 52-week high today for a 30-year fixed rate mortgage. I don't know where that 52-week high today comes from. It did not hit a 52-week high today. In any event, mortgage rates, though, are staying elevated. And that brings me to the next thing. Okay. These are the 10 cities seeing the most price cuts for homes. This is not the only 10 cities seeing price cuts, but it's the most. It's the cities with the highest price cuts. And what cities are those? Okay. Sorry if I'm making you nauseous by scrolling too fast, but Boise, Idaho, 61.5% of home sellers cut their asking price. Denver, 55, Salt Lake City, 51, Tacoma, and even in Indianapolis, 44%. But it's not just those cities. Where I am on Long Island, people are cutting their asking prices for their homes. Sellers are cutting prices now. Buyers are starting to have a little bit more leverage. And those days where you see people lining up around the corner to look at a house that just came in the market, that's starting to disappear. I'm not saying it doesn't happen at all, but like my friend Maddie always says, who's a realtor, you have to price your houses accordingly. And if they're worth more, people will bid the house up above the asking price anyway. So things are coming down a bit. Stock market's coming down a lot. So let's talk about calmness. Okay. Why am I so calm? Because I'm investing for clients and myself, because I'm a client too, right? According to people's goals, their risk tolerance, their time horizon. My typical client, for example, who's 60 years old, who is starting to really consider retirement and it's a few years away, who thought that person was doing so well, it's only because we've been in a strong stock market for the last 10 plus years. And this person is heavily into Amazon, Facebook, Netflix, Google, the usual culprits, Microsoft, Apple. And that person is so heavy into those stocks. And now those stocks have come down so much. And that person is just losing so much money now from where their accounts were. And I think that exemplifies the most worried investor, typically a young boomer or an older Gen Xer who thought they were doing everything right, thought they were so good with money just because they bought the hot stocks at the right time. They couldn't get out, though, and now they're suffering. Those are the people who are worried most, and those are the people who think investing means buying a stock that could go up the most. Financial planning is just buying stocks that can go up the most because more money solves everything. And as you can see now, that backfires. It's not that more money can solve everything. It's not that more money solves everything. It's that more money is a help. But without the plan, without investing appropriately for your age, according to what you're going to need your money, and you don't have money set aside for emergencies, for known expenses, those are the people getting hurt the most because they can't even afford to wait for the stock market to recover. They have to sell now to meet their living expenses into this down market, or they're going to have to do that when they retire, or they're just going to have to work longer. So I avoid that. I don't do that. And that's why I'm calm. That's why I'm not worried that I see the market go down. Oh, I have to worry about all these clients losing all this money. No, it's the fact of the matter is down markets were planned. We planned for those. We expected those. Down markets and up markets are not mutually exclusive. They're part of the same thing. A down market is part of an up market. Kind of like I love the expression success and failure are not mutually exclusive. Failure is part of the success journey. Down markets are part of the stock market capital appreciation journey. We wring out excesses every now and then. We burn the forest down, and the forest regrows bigger, better, stronger. And that's why the market always recovers, because the market comes back bigger, better, stronger after a hazing, after a burning down of the market. And that's why I'm able to stay calm. And that's why my clients are able to stay calm in this. People say, oh, you must be going crazy with all the client calls. Your clients must be so upset. I'm like, nah, it's not really. Things are fine. It's we have a process that we follow, and we're not breaking the process. It's this was expected to happen. I've seen brutal bear markets before. I mean, if you think this is bad right now with the S&P down about 20% from its high, imagine we're down 40-50%. Imagine you think that stock that you bought at 400 is down to 100, but it can't go any lower. Imagine that now down from 100. Now imagine it going down to like $4 or $5. That is something else, right? I've seen those things happen before, and I feel confident to say that I'm not in those things. Not to say I'm not in individual stocks. I am. And that adds to the risk, because stocks don't always recover, but indexes have always recovered. But that's a risk I'm willing to take, and clients who are suitable for that risk, who are willing to take that risk, will take that risk too. But I also have a lot of clients who are just strictly in modeled portfolios using index funds, and they're great too. Those are terrific also. And I have clients who do both. So it's really about personal preference, personal finance, and that's what I do. I put the personal into personal finance. I hope we helped you out today. But if you are not calm, there's something that is not congruent between your financial situation, your personal finance, your life, your expectations. And it behooves you to get all of those things together, to make a list, that spreadsheet of all of your assets, liabilities. It behooves you to figure out what you want, what you have now, where you're going to go, and then start to think in terms of what steps do you need to take, or what are you going to live? How are you going to live based on what you have now? This is simple stuff, but it's hard to do it on your own. It's much easier when you have an external third party, a detached party, do this. That's what, by the way, that's what financial advisors do. It's not a plug for me. This is a plug for all financial advisors. I'm hoping that when you use a financial advisor, you use an independent financial advisor, because I want you to use somebody who's working for you, not for 10 different layers of management and a big firm that has to please the shareholders. I want this to be about you. That's why I went independent, by the way, and that's why so many of my friends who are financial advisors are independent. I'm just attracted to people who are independent. Zach is out there. Speaking of great people and phenomenal independent advisors, Zach says stocks don't always recover, but indexes always recover. Great quote, Mitch. Thank you very much, buddy. And coming from somebody like you who always has such wise words, I really appreciate that. Maybe I should make that like my next cardboard sign. I'm like desperately seeking my next cardboard sign in my head. But yeah, so that's about it. If we have a crazy day tomorrow, I will be doing the live stream. So hopefully you won't see me tomorrow. Okay. Have a great weekend. If not, and see you Monday. Thank you so much for joining me.